I've stopped six wars in the last. I'm averaging about a war a month, but the last three were very close together. India and Pakistan, and a lot of them. Congo was just, and Rwanda was just done. But you probably know, I won't go into it very much because I don't know the final numbers yet. I don't know. Numerous people were killed, and I was dealing with two countries that we get along with very well, very different countries from certain standpoints. They've been fighting for 500 years, intermittently, and we solved that war. You probably saw it just came out over the wire, so we solved it through trade. I said, I don't want to trade with anybody that's killing each other, so we just got that one solved. And I'm going to call the two prime ministers who I got along with very, very well and speak to them right after this meeting and congratulate them. But it was an honor to be involved, and that was going to be a very nasty war. Those wars have been very, very nasty. So we've done a lot of good work. We've had great support from the Prime Minister. Anytime we needed help, anytime we needed any form of support, you've been there. We appreciate it very much. And we're going to continue onward. We do have to take care of the humanitarian needs on what they used to call the Gaza Strip. You don't hear that line too much anymore. You don't hear the Gaza Strip. But it is the Gaza Strip, and it's amazing. It's not being handled a little bit differently. We're going to set up food centers, and we're going to do it in conjunction with some very good people, and we're going to supply funds. And we just took in trillions of dollars. We've got a lot of money, and we're going to spend a little money on some food. And other nations are joining us. I know your nation's joining us, and we have all of the European nations joining us, and others also have called, and they want to be helpful. So we're going to set up food centers and where the people can walk in and no boundaries. We're not going to have fences, and they can't. They see the food from 30 you would say yards away, and they see the food. It's all there, but nobody's at it because they have fences set up that nobody can even get it. It's crazy what's going on over there. So we're going to work very closely together with your country, a great country. We also discussed inside that we are, there's a whole new thing happening with regard to energy from nuclear. Yeah. And the Prime Minister's looking at that very strongly, and I know you have Rolls-Royce nuclear plants. That sounds pretty good, right? I love that. What a great brand that is. But you're also doing the Rolls-Royce or the nuclear plants, the smaller plants. We're doing smaller and bigger, but the small is interesting. They do a small plant, very easy, very safe, and as they need more, they hook up another plant, and they have a series of plants instead of, doing the $20 billion plant. That gets tough for a lot of people to do. So we're just studying that. It sounds like you're very far progressed, but that's a great thing you're doing on nuclear. We opened up nuclear about 2 months ago, and it's now safe and very inexpensive.
No, we see civil nuclear as a big part of the future as we go to sustainable, independent energy. And I think that between the two of us, we can work very much more closely on this. And we've agreed that that's our ambition, that's our aspiration. And this is going to be a big part of the future when it comes to energy. And you can see in the last few years, energy has been weaponized. Prices have dictated both families and businesses across the United Kingdom, and therefore taking control of energy is a huge prize. So the more we can work together on this, the better. And small modular reactors are a very big part of the future here, and we've got great companies like Rolls-Royce involved in that. So I'm very much looking forward to working together with you, Mr. President.
We'll do that. We'll do that. We're going up to your oil capital in a little while. We're going up to Aberdeen. That's called the oil capital of Europe, and that's a great asset that you have up there someday. If they ever change their thinking on that, you have a great and valuable asset. There's a lot of valuable resources underground there, but that's a decision for you to make. But it's a very amazing place, and it is considered the oil capital of Europe. So it's another option that you have. So we are doing really well as a country, and I think that the Prime Minister has been so supportive of us and so strong and so respected. And I respect him much more today than I did before because I just met his wife and family. He's got a perfect wife and family, and that's never easy to achieve, right? But
I take no credit for that.
But he's become a friend, and together we got a deal done that has not been able to be done. It was a deal that's very good for both parties.
A really good deal for both of our countries, and very, very well received here in the United Kingdom.
So thank you very much for having us.
Thank you.
That's President Trump speaking in a bilateral meeting, as you can see, with the Prime Minister of the United Kingdom, Keir Starmer. They are in Turnberry in Scotland right now. Bloomberg's Lizzie Burden is in Scotland as well, our native country. Great to get you on this story, Lizzie. What do we know about this deal? There have been some conflicting details, with President Trump saying that pharmaceuticals won't be included with the EU deal. I'm referring to, obviously not a UK deal. And but Ursula von der Leyen saying pharmaceuticals are indeed included in the 15% tariff.
Well, indeed, there was a disparity between the two readouts from their meeting over the weekend, Matt. You had President Trump thinking that the EU would be charging 0% tariffs on US goods, and Ursula von der Leyen, the European Commission president, saying that that's only for certain goods, mind you, like certain agricultural products, certain chemicals. And if you're going to have 0% tariffs from us, we expect the same back. We can agree a list and that list can grow. But look, these are the details that need to be ironed out down the line. The reason that you saw relief, at least for certain European equities in the session, is because you've got this 15% US tariff agreed on most EU goods, and that this is all inclusive so that you don't have extra tariffs when it comes to, for example, chips or drugs, or for other areas as well. But these details have, as you say, to be ironed out. We've also got Keir Starmer talking to Trump there. What an unlikely partnership, right? They have nothing in common nearly when it comes to the personal side or the ideological side. And yet Starmer was the first in line to get that trade deal, which Donald Trump is heralding. Now the conversation turns to Gaza and the humanitarian crisis that is happening there. So much pressure on Starmer to press Trump to revive those press talks. So much pressure to get him to recognise Palestine as a state in itself. We'll have to see where those talks lead to. Apparently he's got a plan that he's presenting to the president. We don't have the details at the moment, but Gaza very much in focus alongside trade.
All right, Lizzie, appreciate the on-the-ground update. That is Bloomberg's Lizzie Burden reporting from Turnberry, Scotland. And there may be more deals to come as China and U.S. officials meet today in Sweden. Bloomberg's Oliver Crook is in Stockholm, where those meetings are taking place. So certainly a win for the U.S. administration when it comes, of course, to that deal with the EU. How does that set us up for these negotiations with Chinese officials?
Yeah, well, we heard from Jamieson Greer, the U.S. trade representative, saying that basically they come into these discussions with China off of a big win on their trade negotiations with Japan, with the European Union, and as a consequence, they don't feel great pressure to strike a deal with China at the moment. We just had Scott Bessent and Jamieson Greer walk in right behind me there. We also had the Vice Premier of China just walk in about 30 or 40 minutes ago. Their meetings are now underway within the Prime Minister of Sweden's office, which he's sort of very kindly lent out for these trade negotiations. What we will have here likely over the next 48 hours are discussions about the panoply of issues that they disagree on trade and probably beyond. But before any of those issues get resolved in a permanent way, what they need to do is extend the runway for the trade truce that is currently in place between the United States and between China. The U.S. currently has 30% tariffs on China. That is down from the 125% tariffs that they did have when there was the escalating tensions between the two sides. They brought that down. That is supposed to expire on August the 12th. So number one priority for the negotiators in those rooms is to extend that runway and then to start talking about the broader issues, the overcapacity that China sends out to the rest of the world, to the United States, other issues such as the continued purchase of Russian and Iranian crude oil, the issue of TikTok. Trump has said that there is a buyer in the United States. That still needs sign-offs from the Chinese side. But as usual with the Trump administration, the way into the conversation is through the trade plank, but there are a panoply of different issues that they want to discuss with the Chinese.
All right, Oliver, thanks very much. Bloomberg's Oliver Crook there reporting live from Stockholm. He'll continue to cover that story for us. Now, trade deals aren't the only story investors are going to need to digest this week. A fire hose of economic data is set to be released. Here with a look ahead is Bloomberg's international economics and policy correspondent, Michael McKee. Mike, so a lot of economic news.
A lot of economic news. The question is it going to be all sound and fury signifying nothing, or is it going to change the perception of where markets will go for the rest of the year? We're going to have to wait and see on Friday. But Tuesday, we start off trade, then jolts in confidence on this program. You're going to want to be watching. Wednesday, GDP and ADP. ADP will really suffer in comparison. GDP is going to be important. Going to be hard to know exactly what it means because of the trade distortions we saw earlier this year. So pay attention to analysts like us. Thursday, income and spending, PCE, and the employment cost index, which is the Fed's favorite measure of employment costs. We'll see if there's some inflation building there. Jobless claims, of course, everybody watching. And then Friday is Jobs Day. We'll recap that on open interest. And then we get the ISM and Michigan numbers on open interest. I'm just promoting you guys, if you don't mind that at all.
We appreciate it.
And what really matters, of course, is on Wednesday, the Fed meeting. Fed's going to leave rates unchanged. The question is there any signal about September and any kind of encouragement for markets to think they'll go in September? And what does Jay say? Not just about September, but about Donald Trump, about the buildings that they're criticizing him for. A lot of questions for the Fed chair. So Wednesday is going to be the big day, but there's going to be something for everybody to follow every other day this week.
All right, yeah, a lot to look forward to. Maybe Jerome Powell in another hard hat. We can only pray. That is Bloomberg's Mike McKee on the big economic week. But investors are also bracing for the busiest week for corporate results of the season. Bloomberg cross-asset reporter Isabel Lee tracking their performance so far. And Isabel, what does the scorecard look like as we head into such a busy calendar?
It's a pivotal week, Katie, that's really likely to set the tone for the rest of the year. So we have a busy economic calendar, but also here in the equity market, we will see a deluge of earnings. Nearly $24 trillion of market cap is slated to report. That's more than double what we saw last week. So today, Monday, we'll see Waste Management. Tuesday, we have Procter & Gamble, United Health, Boeing, UPS, Starbucks, and Visa. Then things ramp up on midweek. Come Wednesday and Thursday, 4 of the 6 largest S&P 500 companies will report. I'm talking about Microsoft, Amazon, Apple, Meta. The market cap of those 4 amount to $11 trillion, basically the same for the entirety of last week. So Meta sales growth should be the slowest in 2 years. Microsoft faces questions over the ramifications of a cyber attack. Apple, its Greater China revenue is seen rising for the first time in 2 years. And Amazon, we have the core business there remaining healthy in the face of tariffs. So as a whole, bottom line beats seem to be coming in strong so far. We have Bloomberg Intelligence showing that companies are generally beating forecasts with profits up 4.5% year over year. And other noteworthy companies are Reddit, Coinbase, Chevron, and Ford. So really, you take your pick, Katie.
All right, Bloomberg's Isabel Lee, appreciate the update. 4 of 7 Magnificent 7 names report this week, so certainly going to be busy. Let's take a look at the setup as we head into the first official trading day of this week. You can see pretty quiet, Matt Miller, the S&P 500, only about 0.1% higher. Of course, we're kind of in wait-and-see mode across all of those indexes right now.
Yeah. However, it does look like we'll hit all new records again, at least momentarily, and we closed at record highs on Friday as well. Coming up, Tesla is teaming up with Samsung in a multi-billion-dollar, multi-year deal to make chips in the great state of Texas. We'll take a look under the hood. Next, this is Open Interest.
Tesla shares are leading the Magnificent 7 higher this morning after announcing a chips deal. Samsung will produce AI semis for the EV maker as part of a new multi-year pact. The deal is worth $16.5 billion, although Tesla CEO Elon Musk just posted on X that the figure is, quote, just the bare minimum. For more on this Tesla deal and Magnificent 7 earnings to come this week, we're joined now by Bloomberg Tech co-host Ed Ludlow. So, Ed, Musk also wrote on X that the strategic importance of this is hard to overstate. We won't try to overstate it, but just give us the context here of what this means for Tesla at this moment.
Well, it onshores and diversifies the supply of the AI chips that make up and power the full self-driving computer in each car. The specifics are really important because the deal with Samsung is for AI6, which is 2 generations of chip into the future, essentially. Samsung already manufactures for Tesla the AI4 chip, which is in the hardware 4 generation of vehicles. And in the interim, between getting from that existing Samsung chip to the next one, which will be done in the United States, Tesla has in parallel an arrangement with TSMC, where TSMC will make AI5 first in Taiwan and then later bringing it to Arizona. But it's just so case in point on how long-term and expensive and difficult it is to manage your technology development pipeline along with the contract manufacturer that's going to make it. And you mentioned Tesla shares were up more than 1% in the pre-market, but overnight Samsung shares really reacted to this because much like Intel, Samsung's contract manufacturing business has really fallen behind. So it's a big vote of confidence by a big customer in Tesla that they are doing this with Samsung, noting that they're also doing something in parallel with TSMC.
It's funny, it seems to me fairly short term. They want to start producing chips in Texas already, Samsung does, starting next year, Ed. And this deal only goes out to 2033, right? So are they going to be able to ramp up quickly enough? And is this going to save Tesla money? Is it going to be cheaper to produce chips at an all-new fab in America than it would be with TSMC in Taiwan?
So 2033 seems quite far away to me, knowing that, again, AI6 is 2 generations from where we currently are AI4, but Tesla moves quickly on the R&D cycle. What Elon Musk said about this is the reason they went with Samsung as opposed to others is that they would allow Tesla to be involved in the engineering and ramp up of output because Tesla believes itself to have prowess in that domain. And what Musk said on X was that the fab in Texas is near his house, so he can go and personally stroll the line, which is not really how semiconductor manufacturing works. It's like a very sterile, clean environment. I don't know. But that's the element that Tesla can have control, even though Samsung's basically a contract manufacturer for them.
Well, a bit of good news for Tesla this morning. Ed, we have to talk about what's to come this week.
Yeah.
Apple, Amazon, Microsoft, Meta, all taking the stage. We're going to be paying attention to all of those names and the numbers that they bring. But in your view, what do investors really need to pay attention to as they sort through the different numbers coming out of these giant companies?
Well, the thing that's analogous to all of them is, of course, tariffs. You know, in Meta's case, which is an advertising story, ad spend slowing down in specific geographies depends on the macro environment, and tariffs have an impact on that. Otherwise, you know, Meta's spending on talent, AI, etc. Apple is impacted in that story. But tariffs are interesting because so far with Tesla or General Motors, many other companies, you can quite easily quantify the impact they've had. And what Apple in particular told us in the last earnings call was for this current period, tariffs are going to have a $900 million cost. But for a company that's going to book more than $90 billion of revenue in this period, 62 billion of which is hardware specifically, 900 million doesn't seem like a lot. Mark Gurman has led all our reporting on all of these executive changes at Apple. But historically, the story has been about Tim Cook and the former CFO being able to manage cost, supply chain, and bottom line. You now have a new CFO in Kevin Perek, and a very different and difficult set of circumstances that Apple's going to have to manage, and that will be interesting. Again, Amazon, it's domestic retail business. There is a tariff component, but for all of these companies, the AI story is the core of it, where you want to see growth, in Amazon's case, through cloud. So there's a lot there. The question I have for you guys, I send one back to you. Didn't see that coming on Monday. First official day of the week is what's more important this week, right? Earnings or the Fed and economic data? And I think earnings are going to run it really close because we'll learn a lot about the state of play.
Yeah, I would agree with you that earnings are more important because I doubt we're going to get much out of the Fed and economic data that shows us what happens from tariffs compared to what we'll get in the second half of the year.
I like that Ed asked a question, but then answered it himself. I thought that was a good one.
Well, what's your answer? Everybody chip in.
Well, if you both are saying earnings, I feel like I have to take the other side of that trade. Maybe we'll get a surprise out of the jobs report. Maybe we'll get a surprise from Jerome Powell, but probably earnings.
All right, Ed, thanks very much. Ed Ludlow, of course, is the host of Bloomberg Tech, and you can catch that show in 1 hour and 39 minutes. Coming up on this program, we're going to ask Citi's Scott Chronert if he's getting bullish on stocks after all-time highs were put in like every day last week. Also, we have more people on the street raising targets. Maybe he'll join in. This is Open Interest.
Well, Oppenheimer is the latest firm to raise its S&P 500 target. Strategists led by John Stoltzfus raised their year-end target to 7,100 from 5,950 as trade progress removes uncertainty. That is a street high. Joining us now is Citi U.S. equity strategist Scott Chronert joining us now. I want to ask if you're going to raise your target now, since we had John on the show last week, and it sounded like he was getting there. But let's talk about trade uncertainty. Resolving a little bit this morning, you have a deal between the U.S. and the EU. But Scott, I see the S&P 500 only up about 0.1%. That seems pretty tepid relative to the news.
Katie, well, I think what's happening here is that as we move further and further away from those Liberation Day lows, and you're seeing more signs of these trade deals happening, they essentially begin moving to the background in terms of an overhang on markets. But as you get more comfortable that the deals are coming, I think you can expect there's probably a less of a positive bias to the actual news announcements. I think what's left ahead is how do these actually translate in earnings growth expectations, which comes back to your earlier question, and how do you think about price targets?
All right, Scott, we're going to hold you over. I'll ask you if you're going to raise your targets soon. Scott Chronert from Citi stays with us through the open. The bell up next, and as Katie says, we're only up about 1/10, not even, of a percent on S&P futures. This is Bloomberg. We are moments away from the start of trading on this Monday, July 28th. Looking at slight gains on the S&P 500 futures contract, almost 1/10 of 1%, 2/10 on the NASDAQ, 0.5% on the small caps. A lot of people saying this is a win for President Trump, a win for the U.S., and maybe a loss for the EU. That's the trade deal I'm talking about. Southside Bank shares ringing the bell to mark their 65th anniversary. The shares are up less than 40% over the last 5 years. They're actually down year to date, so something they may need to turn around. Meanwhile, over at the NASDAQ, Stockyards Bank and Trust ringing the bell. How old are they?
25.
25 years, but if you bought those shares 5 years ago, you're up 120%, assuming you reinvested the dividends, so you're doing quite a bit better. Katie, what are the stocks you're watching today?
Well, I'm keeping an eye on the intraday movement of what's going on in energy and defense stocks on the move as the EU plans big purchases of American products from those industries. That is part of that trade pact. And you take a look at the reaction, and you can see it is green, not huge moves here. And that definitely seems to be the theme so far today. But we know it is a consequential week. Matt Miller.
All right, Samsung, as we've been talking about with our own Ed Ludlow, is going to produce semiconductors in Texas for Tesla. It's a multi-year deal worth at least $16.5 billion. The CEO of Tesla says they'll probably buy multiples of that. And Morgan Stanley strategists say their S&P 500 bull case is playing out. Mike Wilson's team reiterated that a recovery in earnings revisions is underway and that he and his team are leaning more towards their 12-month bull case. That's 7,200. I believe it's to the end of the first quarter, so it's not a year-end target, but still, it's pretty hot. We're back with Citi's U.S. equity strategist, Scott Chronert. And Scott, you guys have a 6,300 target. We're there and then some. Do you think we continue to climb into the end of the year?
Well, I think that's certainly possible. We use 6,300 for our base case, and that's sort of something along the lines of what we'd consider fair value for the S&P. But when sentiment shifts to the positive as it has, then anything can happen. Now, we also band our base case with bear and bull cases, and our bull case for several months now has been 7,000. So that 7 number as a starting point for thinking about index objectives is certainly out there. But what it's going to take, Matt, is a lot more conviction in durability of this economic cycle. And that's going to entail Fed getting a little bit easier as the year unfolds, more confidence in earnings growth coming out of the concerns we dealt with in the first half of the year, and importantly, perpetuation of this AI spending and infrastructure playbook theme that still is going to be, I think, mission critical to how this market acts short term and longer term.
Absolutely, and that's how a bull case potentially becomes the base case. Well, let's narrow our focus to just what's going on this week. This is also a conversation we were having with our own Ed Ludlow. When you think about all that is sitting ahead of us in the next 5 trading days, we have big earnings, we have big economic data and a Fed decision, and we also have trade negotiations underway, importantly with China. What do you think will be the deciding factor of this week's mood music?
Katie, for me, honestly, it's this what inning are we in the AI build-out discussion? And that comes back to fundamentals, right? So essentially, from my perch, what can disrupt the action in the market? It's that 40%-ish of the market that's mega cap growth that's tied to this theme. So we need to see ongoing confidence that the CapEx playbook is in place, that these companies are beginning to see evidence they can monetize some of these new product offerings. And what that leaves you with is confidence that we're still early innings in a playbook that may extend several years. That's what you need to keep this going. Then the Fed comes in. Eventually, we get to lower rates as we go into the post-summer time frame. What that does is then it begins to allow the market to broaden even more so to those areas that are more traditionally, let's say, sensitive to interest rates. That's going to be consumer, which includes home builders. It's going to be other areas, telecom, utilities, and so forth. So a combination of leadership persisting and then some broadening into other sectors as time passes and more confidence in future economic conditions and growth trajectories unfold. That's how you get to a 7 handle on the S&P.
What do you need to see in terms of earnings? I'm just looking, we're trading at 23 times forward earnings right now. So I guess your 2026 expectation would have to be like 310 or something. Are you there?
Well, that's where it goes, Matt. So our base case is 295 for next year. Our bull case, remember how we get to 7,000, is a more heady valuation on 305 in earnings. So what you need to see, which we're beginning to see right now actually, is consensus numbers lift, not so much as a function of revisions, but because what's happening in terms of company guidance is that they're no longer as conservative as they've been on the second half of the year and then looking ahead to next year. So what that does is enable consensus to begin to lift. It takes some of that valuation pressure off.
All right, Scott, and I hear what you're saying, and we're juggling, of course, all these different factors. You have a bull case out there. Regardless of whether we're talking about the bear case, the base case, the bull case, is there any area of the market, is there any specific industry or specific name that you can point to and say, this probably does well regardless? We have high conviction here.
Well, I think where we're going with this, our big bull discussion point, if you will, Katie, is that we're looking at the free cash flow generation for the S&P 500 really beginning to accelerate, and that gives you lots of financial flexibility. It enables cap spending. It also enables share repurchases. That Mag 7 component, X a couple of them, are really critical to that. So what I would say here, again, the leadership in our view has to continue to be in these mega cap growers. And, we continue to be overweight software, semis as a part of our playbook on this. Eventually, you want to see the hardware companies benefit from some of the broadening. So you see where this takes us. It takes us, you rely on that big leadership to continue to drive the bus. But then what happens is that you begin to fill out behind that. And that's, I think, still an important second half story here. So I would say color us ongoing constructive on growth in all of its manifestations.
Scott, what are the companies or what are the sectors that really get hit from these tariffs? Because we continue to see what look like wins, right? President Trump getting a 15% tariff on European Union goods and everybody breathing a sigh of relief. There was a time when that would have terrified this market. Right. But company after company after company in the U.S. says, all right, I guess we're going to have to pay for that. So we're taking $1 billion off our full year earnings, or we're taking $2 billion off our full year earnings, or we're taking $3 billion. You know, this isn't something that Europe is paying for. This is something that American companies and consumers are going to foot the bill for. So which sectors see margins shrivel?
Well, you set it up perfectly for me. We've been underweight consumer discretion and staples for the better part of this year. And quite honestly, when we look at the tariff setup, we've argued for some time, yes, there's a little bit of an inflation read-through, but this is really a gross margin issue and headwind. And we think those consumer sectors are smack dab in the line of sight for where tariffs are coming through. Beyond the consumer sectors, you begin to feel it, or should see it, to some degree on the industrial side. But then there are other areas of the marketplace that are somewhat unaffected. Financials would be an example of that. I'm leaving out healthcare. Healthcare is a controversial discussion point right now from a sector perspective. A number of headwinds, including tariffs, that continue to play out there. But where I'd focus in terms of the negative is how these consumer discretionary names are in position to respond to this. And then the last point on this, really important, is what's the market pricing in already? The market's been figuring this out for several months now, that this company here, that company there is going to be affected to a certain degree by tariffs. So what we're dealing with in the broader market is not so much where the next tariff wave comes in and hits, but what's already baked into expectations. It's sort of a really interesting dynamic that unfolds here. So less bad than feared ends up becoming pretty good on some of these tariff discussions.
Yeah, just to that point on healthcare. Healthcare shares, the worst performing sector year to date. Just can't catch a break there. Scott, always great to speak with you. Thank you for spending some time on Monday with us. That is Citi U.S. equity strategist Scott Chronert. Let's take a look at this rally right now. If you can call it that, the color is green, but really tepid gains so far this morning on the S&P 500. As Matt pointed out, that's good enough for a record, but a pretty uninspired record. Taking a look at the different components here, you can see you do have a lot of tech names on the rise today. NVIDIA, Meta, Advanced Micro Devices, Amazon, trading places here at the top. We know it is a consequential week for tech earnings, so continue to keep a look on those names. Look at the downside, though. This is where it gets a little bit more interesting. You have Johnson & Johnson, one of those healthcare names that just can't seem to win this year. Also Cisco, Accenture, the list goes on. Can't get a clean read there in terms of the sector. So let's take a look at that breakdown specifically. You do have almost an even split, maybe a little bit more red than green. Up at the top, you do have energy leading gains this morning. We know that comes back to that trade deal that the U.S. secured with the EU. Technology also up there as well. Then you take a look at the bottom. You have consumer staples, utilities, and materials is your worst performing sector. Just about 10 minutes in to the session, Matt Miller, down about 0.9%.
All right, we'll continue to track these markets and watch for another closing high on this Monday. Coming up this week, earnings from some of the biggest companies on the planet could change that. We'll talk Mag 7 results with Gil Luria, D.A. Davidson, head of technology research. Next, this is Open Interest.
Welcome back to Open Interest. It's time now for our top calls, some of the analyst action in focus this morning. And first up, JP Morgan is upgrading Nike to overweight from neutral, calling this an inflection point for revenue growth, which is expected to jump in 2026 and 2027. You take a look at the reaction in shares, up about 2% at the moment, at one point hitting their highest level intraday since March. Up next, Evercore downgrading Cisco to inline, pointing to the recent 30% rally, which has priced in potential upside, some of that coming out this morning as a result. And finally, we have Wolfe Research upgrading Texas Instruments to outperform, setting an end to its years-long investment phase, which will create stronger cash flow and margins by 2027. Shares currently up about 2.5%, Matt.
All right. Those are some of the analyst moves. Let's turn back to the earnings that drive a lot of those things. This week, we have a ton of them, including 4 of the Mag 7. out this week. Microsoft and Meta on Wednesday, Apple and Amazon on Thursday. For more, we bring in Gil Luria, D.A. Davidson, head of technology research. And Gil, you know, I was perusing those companies and wondering myself, which of them would be most affected by tariffs? Obviously, Apple has a big supply chain, all of it outside of the U.S., and Amazon as well sells goods that are, for the most part, made in China. How do you calculate the hit of these tariffs to those companies?
Yeah, that's been very hard to do, but I think you have the right order, which is first and foremost Apple, which has had to very quickly shift supply chains from China to India. Even that hasn't gone smoothly. They've already told us that there's going to be a big hit to margins from that, so we're going to track that. For Amazon, there's some impact. Obviously, a lot of their sellers sell from China, but Amazon is so broad and flexible, and consumers can move their demand around, and so the impact there is going to be probably more muted. Then longer term, if tariffs are disruptive, that'll impact the ad market and maybe Meta and Google. And the only company that's safe here is Microsoft.
The only company that's safe is Microsoft. Well, we'll get to Microsoft, but I do want to pick on Apple a little bit more, because the narrative that's formed around Apple is not just that they're an also-ran in AI, that they are firmly behind the pack when it comes to artificial intelligence. But you take a look at shares down 14% on a total return basis year to date. Gil, does that create a situation where the bar is so low for Apple that maybe it's easier to surpass expectations at this point?
It is, but this is probably not the quarter that happens. What Apple has shown us is that even without really having compelling AI products integrated into their handsets, there's still an upgrade cycle. It's a fairly muted one. What you know, though, with Apple is that people aren't going to switch away, which means they have time to get it right. As long as they get these AI features right at some point over the next couple of years, there will be a bigger upgrade cycle, and that's what investors are hanging on to. So expectations are low, probably for a reason. There's probably not a lot of upside, and it's more about where can they go in the next couple of years, both in terms of more compelling AI products within the handset, as well as maybe a new form factor for next year. Many iPhone users look at Android users with some envy when they see the folding phones. Maybe we get that next year. So Apple is more of a play into what happens over the next couple of years. Their consumers are sticky. They're not going anywhere.
Well, you know, Gil, I was talking to a woman over the weekend who runs a company here in New York, sources all of her goods from China, and has said that after negotiating a 10% discount with her suppliers and raising prices marginally, she's doing okay. What does that look like for Apple? You know, cost of goods sold, if it's 60%, it's a really 15% would be a 10% tariff. They're going to raise prices a bit. Consumers end up paying a few percent more. What does the back of the napkin math look like in your office?
Yeah, so it's still in the hundreds of millions of impact, mostly on margins. They'll sell as many phones. They'll probably still sell them at similar ASPs. So they guided to hundreds of millions of dollars of impact on margins, exactly because how you described it, which is they have three levers. One is to push margins down on their vendors. One is to increase prices a little bit, and one is to accept margins that are a little lower. And again, the net of that is going to be the top line will probably have fairly limited impact, and the margins will compress a little bit. But again, not enough to really change the trajectory, probably within the guided range at this point, at least, unless we see negotiations fall apart and tariffs pick up from here, which seems less likely at this point.
Well, to state the obvious, Gil, the common thread through these earnings, other than tariffs and trade, of course, is artificial intelligence. And we know that Meta in particular has been on a really huge acqui-hire spree, if you want to call it that, basically spending so much money to attract AI talent. And I'm curious about how that will be talked about on the earnings call, what kind of questions that company executives will receive and how you're thinking about it as an analyst. In one sense, of course, they're getting the best and brightest inside their doors, but you think about compensation costs just through the roof.
Yeah, I think it's possible that this quarter, Meta may have spent as much on talent as it did on chips. Between the investments to hire Alexander Wang and the couple of folks out of SSRI, they may have spent close to $20 billion this quarter, which will be probably right around where they spend on CapEx.
Wow.
Mr. Zuckerberg believes that he has to win in the AI model race, that Meta cannot come in second, and he will do whatever it takes. That is a very aggressive stance that he shares maybe with Mr. Musk and Mr. Altman. They are AI maximalists. They think that we are on the precipice of such accomplishments from the AI models that he will not risk being second. In terms of investors, as long as the ad business is growing sufficiently, which in their case is going to be mid to high teens, they're going to allow him to do that.
But
they're
Gil,
going to be okay with this spend.
Can anyone else match that? I mean, it bears repeating what you just said. $20 billion is what Mark Zuckerberg's going to spend on talent for AI, right? Google, I think this year they're spending $85 billion, but that's going to be on compute. So is anybody else in the industry going to be able to match that, or are the best and brightest going to end up working for Facebook?
So OpenAI is compensating its staff very well, mostly based on the increasing in the share price. Anthropic won't give up. Google certainly won't give up. And then you still see an aggressive accumulation of talent at Microsoft as well. So we are going to have a multi-headed race here to achieve that top-of-the-line model. Mr. Musk, in his many enterprises, investing also in a similar way. So there's a race here. It's an important race. But right now, Mr. Zuckerberg's the most aggressive.
Yeah, to put it mildly there, $20 billion on talent. That year of efficiency for Meta certainly feels like a long time ago. Gil, great to speak with you. That is Gil Luria. He is D.A. Davidson, head of technology research. Now, coming up next hour, we'll dive into memes and frothiness in markets with Bob Sloan of S3 Partners. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing after we got the U.S.-EU trade deal. You can see S&P 500 and NASDAQ both rising. The tech stocks doing a heck of a lot better than the broader index right now at a 0.4% gain, 23,367. S&P's barely at 6,400. In terms of the stocks that are rising, NVIDIA helping out there with an 0.8 boost. Apple is unchanged right now. You can see Tesla rising after the deal with Samsung. Chevron and Cheniere putting up some gains after the EU says it's going to buy a lot, I think $600 billion worth of energy assets. Katie, what are you looking at in terms of the week ahead?
Well, continuing to watch for any trade headlines because President Trump continues his visit to Scotland with Treasury Secretary Scott Bessent. He's meeting his Chinese counterparts in Stockholm for trade talks. Wednesday, we get that Fed decision expected to hold rates steady, but the press conference will be fun. After the bell on Wednesday, this is when the fireworks really start. We get earnings from Microsoft and Meta, followed by results from Apple and Amazon on Thursday. And we end the week with the July jobs report on Friday. Plus, President Trump's tariffs are due to take effect. The date is August 1st.
Coming up the next hour, Miriam Bartels joins us from Sanctuary Wealth, as well as Bob Sloan from S3 Partners. All right, we are 30 minutes into the trading day. We opened up at intraday highs, Katie, and now we've given up those gains.
Most boring record ever. This is very much a story of hurry up and wait because it's going to be a very exciting week. I am very excited for this week, but not too much to chew on this morning.
All right, welcome to Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Shelly Bassick is off today. And coming up, President Trump strikes a deal with the EU, firing up the bulls on Wall Street, perhaps, but warning lights are flashing.
This week's packed calendar may set the tone for the rest of the year, or at least the rest of the week, with the Fed decision and the jobs report on deck.
I feel like we're not selling this. Plus, a big earnings test. Four tech giants worth a combined $11.3 trillion report results over a 2-day stretch. Certainly exciting.
That part we can sell.
Yes,
There
for
are
sure.
big earnings this week. That's not debatable, right?
No.
40% of the S&P 500 going to report this week. We are at all-time highs. Earnings have come in, I guess, strong, depending on what that word means to you. RBC's Lori Calvasina says Wall Street has seen a huge pull forward in momentum.
We looked back at the market rebound 9 months down the road off of things like the 2010, 2011 growth scares, 2018, kind of all the big 10% plus drops except for the COVID recession of 2020 that we've seen since the GFC. And we are recovering faster than any of them. And we're about where we deserve to be if you look at the average of those in 9 months' time, in December. So we think markets have already pulled forward a tremendous amount of good news. And that's not to say, that we feel super bearish from here. We feel pretty neutral, looking at stocks through the end of the year.
Joining us now is Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. And we have had, Marianne, 9% earnings growth among the companies that have reported thus far, 4.8% sales growth. That's pretty good. What do you make of the run-up in stocks parallel to that?
Well, as you know, we've been fairly bullish. Once we got clarity on the tariffs, we just continuously raise our targets. The economy is growing strong. That's going to allow companies to produce corporate profits. Interest rates are still trending down. I know we keep talking about whether or not we're going to get a Fed rate cut, but at least the trend in rates are down, and that's very bullish. When we look at the free cash flow of companies, they're growing, and we expect them to continue to grow. When we look at tech-related companies, we look at the return on equity, also known as ROE, and it's growing substantially stronger than the S&P. And that's a metric that's really important that I don't think gets talked a lot about. So I still think we can hit 7,000 this year. I think we're underestimating the power of artificial intelligence, blockchain. As you know, we're getting crypto legislation, virtual reality. We're in unprecedented innovation times that I think are going to really have the ability to power this market a lot higher than people are anticipating.
Well, Marianne, you're not alone in that view. I mean, we keep coming back to that call from Oppenheimer's John Stoltzfus raising his year-end target to 7,100. I want to talk about the different components that could lead us there. You take a look at the S&P 500 right now. We're hanging out just around 6,400. What needs to go right? Because we're continuing to hit record after record, but we're talking about very small steps higher.
And I think you're seeing small steps right now because the market is extremely overbought. As you know, the July seasonals are very bullish. We're going to close out July with a really strong month. August is known for markets to have a peak that go into the fall correction. I do think we have to take a little bit of air out of this market and get some consolidation and then refresh it going into the back end of the year. So, I am positive, but I am expecting some volatility. And the measure that I'm watching is the VIX index. I think this is going to be a good measure. It started to come down. I think once you start seeing it around 12, 11, I think that's a sign that maybe there's a risk that a pullback in the market, but it's just a pullback, somewhere between 5 to 10%. But I see nothing wrong with the leadership. The true leadership are semiconductors. I know you've been pretty bullish, or at least very interested in the semiconductors. And I do think that growth stocks and the tech are going to continue to lead this market higher.
Katie, you bullish semiconductors?
As a journalist, I have no opinion, but I do agree, Marianne. I mean, that is where all the action has been in this market. For better or worse, it's big tech that has been leading us to these record highs, and a lot of that comes down to a lot of these semi names. Is that the makeup on our way to 7,000? Is it going to be tech in charge, or do you see a leadership change at some point?
I don't see any leadership change until 2029, 2030. I think this stays tech-related growth. That doesn't mean we don't have periods of time where value outperforms, but the true leadership, in fact, I call it a mega cycle in growth. I think this is growth on steroids. I really do think we haven't really been able to price in where all of this new innovation is happening. It's being adopted faster than any other technology, and it's more than one. We had the internet. We saw what the internet did to the market. This is, as I said, AI, it's blockchain, it's crypto, it's virtual reality. This is tech innovation on steroids.
What about the losers here, Marianne? I mean, which ones are going to get hit the hardest? Because as I look through earnings, and I know it's early, we've only got 168 companies reported in the S&P 500, but consumer discretionary is just getting crushed. Profits down 22%, with revenue down 2.5%. So is that the only one that's going to take a big hit from these tariffs?
Well, I'm not even sure it's from tariffs. If you look at healthcare, healthcare is in intensive care, and it's been in intensive care for a period of time. I expect it to stay in intensive care. It doesn't mean
they're
that
down 5.25%. That's true.
You may see, select stocks do well, but I think that sector is undergoing a major restructuring. Consumer staples are undergoing a major restructuring. We're finally learning how to eat better, and that there are not good things in some of our foods. So I think there's a major restructuring happening there. Discretionary is a pocket of a lot of different cyclicals. You've got autos, you've got home building, you've got retail. So I think it'll be a mix for consumer discretionary. What I think we can say is cyclicals versus defenses will continue to lead the market.
Cyclicals versus defensive, Marianne, that is a good place to leave it. Always great to speak with you. That is Sanctuary Wealth Chief Investment Strategist Marianne Bartels. Let's get back to this earnings picture this week as 4 of the Magnificent 7 stocks due to report. Joining us now with a preview is Ryan Vlastelica. He is Bloomberg's equities reporter focusing specifically on tech. So, Ryan, we were just having a great conversation with Gil Luria over at D.A. Davidson. His view that you take a look at those 4 names, Microsoft, Meta, Apple, Amazon. Microsoft is the only one who is safe. I won't ask you for your specific opinion, but what is the temperature of the sell side heading into this very consequential stretch?
Thanks for having me. I would say the sentiment right now, especially surrounding Microsoft and Meta, is pretty strong. These 2 companies in particular have seen very strong gains this year. They're among the market leaders, and these are 2 companies that have really been aggressive and kind of early in showing an ROI from all of their AI spending, not just for Azure and Office for Microsoft, but also Meta with improved efficiencies, with better ad targeting, things like that. So the case for them as being real AI winners is a lot stronger than you're seeing elsewhere in the market. So I'd say in particular for them, pretty strong. More of a mixed bag for Apple and Amazon. We can talk about those if you like. I'd say for Amazon, they're doing a great job of spending, and they have a real case to be made in terms of how AI can improve efficiencies, their warehouse operations. They also have a big cloud business, of course, a big ad business, of course. However, we haven't seen the stock really participate in the same way from all of this AI optimism. Apple, of course, is unique among the Mag 7. It doesn't have as strong as an AI strategy. It's not spending that much on AI, and the stock is really lagging this year. Also, it faces a lot of issues related to tariffs and so forth. I know that was a lot, but that's kind of where things are going right now. Very positive on Microsoft and Meta, mixed bag on Amazon, a little bit more cautious on Apple.
Ryan, how are people figuring out who's going to pay for these tariffs? Because you talk to, economists last year, and they would say the consumer picks up the tab, right? Companies just pass on these costs. But it turns out that's not the case. Companies are eating a lot of it in their own margins. Obviously, with the size of an Amazon or an Apple, you're able to pressure your suppliers to eat some of that as well. So how bad is it looking for, Apple and Amazon, 2 companies that source the lion's share of their products from China or have Chinese supply chains?
Well, I think there's still a lot of uncertainty surrounding what the tariff picture is going to look like going forward. Obviously, we've seen a number of delays and deal announcements and pauses and exemptions and so on and so forth right now. So the picture is still very unclear. Both Apple and Amazon are dealing with all sorts of their own sort of internal issues. Apple has faced sort of lagging sales growth for quite an extended period of time, especially relative to the rest of big tech. It hasn't seen quite as much demand as some people hoped for its latest iPhone, which is the one that has sort of the early sets of AI features on it. So their ability to price things more aggressively, it's really hard to say. They are a very upscale, high-end brand. So they do have a very affluent customer base. We have seen a lot of success, in particular for their higher-end iPhones. So there might be more pricing power available there than you've seen for past generations or lower tiers of price points. So I'd say mixed bag for them. Amazon, we got a sort of an early read on this with their Prime Day event a couple of weeks ago, which seems like it was fine. We also saw other retailers like Walmart and Target have sort of competing sales events there. We didn't really see them, really blow the doors off in terms of sales growth or strength with their retail business. It seems like people were focusing more on, lower cost items. It seems like some companies weren't participating as aggressively with discounts. I'm sure a lot of that is tariff related.
Well, Ryan, you gave us a really neat cheat sheet. Is that the A's, it's expected to be a mixed bag. You have Apple and Amazon and some big question marks there. The M's in favor, Microsoft and Meta. Let's talk a little bit more about Amazon, because Amazon really is a conglomerate if you think about it. It has such a sprawling empire. What does the stock actually trade on? We know they have a core retail business. I think that's how most people think about Amazon and interact with Amazon. But what does the stock actually respond to? What is the catalyst there?
I'd say most people on Wall Street spend most of their time focusing on AWS, which is the cloud business, still the leader in cloud. It is part of the business that is expected, or at least hope to see, a big demand boost from AI and all these increased workloads the way that we saw Alphabet did last week. We've seen Microsoft do it with Azure. It's a pretty big focus, especially since so much of Amazon's overall operating income is derived from AWS.
Hey, Ryan, great to get some of this intel from you. Ryan Vlastelica covers tech companies for us, tech equities specifically for us here at Bloomberg. Coming up in the next hour, we dive into the memes and the frothiness of this market with Bob Sloan. He runs S3 Partners, and he'll tell us about what he calls battleground stocks. That's next on Open Interest. Meme stock mania came back briefly last week. Shares in Open Door, Krispy Kreme, GoPro, and others all behaving a little less drastically this morning.
Dramatically, even.
Yeah, I mean, you do have some big drops in D-Nut as well as GoPro. That's after each of those stocks saw huge surges in price last week, despite a lack of fundamental data to influence the moves. One explanation given had been heavy short interest. And when I think about short interest, there's one expert to whom my mind wanders. That is Bob Sloan. He's the founder of S3 Partners. He joins us now. And Bob, what exactly happened last week? I mean, you guys track this better than anybody on the street. What did you see?
Well, Matt, thanks for having me again. But this time, it's not the short interest that's driving thing. It's the long. It's the active long interest that is driving stock price action. So one of the things I'd ask you and Katie, just as a question, is Bill Ackman a hedge fund manager?
I would say yes.
Well, he is an investor for sure. But is he a daily market active participant?
Well, to that I might say no, Bob.
Right, exactly. So here's what's happening. A lot of databases on the long side, particularly 13F, are misclassified. Bill Ackman is labeled a hedge fund. Now, he's certainly a great investor, famous investor, but he's not a daily market active participant. And what's happened is that a lot of these meme stocks have a very active long interest as well. And when that active long interest, when it's classified correctly, equals short interest, that's what drives a Kohl's, a Cracker Barrel, a D-Nut, because you have the long interest equaling short interest. That is a recipe for volatility, and that's what happens. So the meme stock folks, the Reddit folks, think, this is David and Goliath, right? We're going to squeeze them. But actually, they have a teammate. They have other Goliaths. A lot of institutional investors are long these stocks. They make the money, they leave, the stock comes back to normal.
So how do memes factor in? Because short interest is one of the narratives that arose last week, trying to explain some of the moves that we saw. The other was that basically you have people latching on to these names in a meme-like fashion, Bob. Does that hold water with you?
Not every meme is a battleground stock. Battleground is a different thing because now, for the first time, you can actually classify what the long is and how much, and do it on an almost daily basis. So you understand how much dry powder can be put into a particular stock. So every meme stock is not a battleground stock because there may not be enough institutional buying to make it a battleground stock. So high short interest is what the meme community concentrates on, but they should really also look at who's long, because their buying is just an accelerant for people already there to make money and leave.
When you say battleground stock, Bob, you're talking about the David versus Goliath stories, right? You're not talking about, and I only ask because I know you were on Charlie Gasparino's podcast, and you guys were talking about like Raytheon and Lockheed Martin, and those are literally battleground stocks. So I just want to separate those two.
Yeah, no, that's right. So battleground means when long equals short, when the active long position equals short position, that's a battleground. Now, for example, though, we have a lot of earnings coming up in big tech this week. If the ratio between active long and short is, let's say, a lot greater than 1, you'd say it's skewed to the long. If it's less than 1, you'd say it's skewed to the short. So long interest divided by short interest gives you a nice ratio. Turns out what happens when you look at a stock like Apple and Tesla, when that ratio is, let's say, 18, like an Apple, it means that stock is crowded. And you can see this in 2024 as a price action. That ratio is expanding. When it decreases, it means that basically street risk limits are met, and all of a sudden, people start lightening up their position. It gets down to about 12. Then it starts to re-risk and reload. So this ratio that we've come up with is a very handy tool to not only understand how much dry powder is in the meme stock community, where there's high volatility, but also what really matters to big institutional investors.
So, Bob, that ratio that you developed, do you think that that's a tradable signal? Because a lot of folks have been looking at this meme rally and trying to devise ways to trade with it or trade around it, at least. This ratio that you have, do you think that that could be useful in a scenario such as that one?
Katie, that's a great point. Absolutely. So when the active long equals active short, in the next 90 days, the marginal dollar can tip that seesaw either way. For things that skew very long, the big cap, big cap, the Mag 7, you can start to see how much of Wall Street risk limits are being tested. And you can see it as that ratio expands to a higher number, longs much more than short, or it decreases where longs are not that much more than short, shorts increase. You can see this ebb and flow of risk coming in and out of the street. We think it's an incredibly useful signal to tell you what the risk appetite is at any one point in time.
Bob, great having you on. Great getting this intel from you. You got to come into the studio. We got to get you in here.
Next time, I promise. I promise. I'm on national TV. I promise I will be there.
I appreciate it. We want to hear this stuff. Bob Sloan there, managing partner, founder of S3 Partners. Still ahead, the Fed decision and the July jobs report loom. We're going to get the outlook from Julia Coronado. She's a former Fed economist. Now she runs Macropolicy Perspectives out of Austin. This is Open Interest. Let's get a check on the stock market right now via the S&P 500 benchmark index. We're going to pull up the move screen here, which is, I think, the most dynamic way to look at it. You get to see the movement during the day there. So we opened at a session high. We're down below that level, but still looking at gains, 64.01. So we did cross that level at one point. You can see we have only 166 gainers today, though, and 334 losers. So the reason that we still see gains is NVIDIA right up here at the top. When that stock is up 0.8%, it adds 4 points to the S&P 500. Tesla, Amazon, Meta, AMD, and Apple all gaining today, and we get earnings from 3 of those companies. Alphabet is down today. Johnson & Johnson is a loser. Cisco Systems is down. I'm looking here for Microsoft. I don't see it anywhere on the screen, but that rounds out your big 4 earnings for the week. In terms of the sectors that are winning and losing today, look at the GRR function on the S&P 500. Energy, a big gainer today because the EU said it's going to buy $600 billion worth of energy assets. Consumer discretionary stocks, although they've had horrible earnings, and I mean down 22% on revenue that's off as well, actually doing well because it beat the expectation. We thought it was going to do worse, Katie, than it actually has been so far.
Well, earnings, just one of the factors to keep a look on this week. We're also going to be talking about the potential impact of President Trump's tariffs on travel demand next with the CEO of Travel+Leisure.
Travel+Leisure forecasting a rebound in its timeshare business. Not really a rebound. It's actually continues to see strong gains. Year after year, it's done well in this sector. The company does see travel and membership revenue falling in the second half of the year. Shares are near 2022 levels, so that's where you've seen a rebound. Joining us now is Mike Brown, the president and CEO of the company. And Mike, I'm looking at the numbers that just get better and better and better every year in terms of estimates, but travel has been a worry, especially for lower-end consumers this year. How does it look to you?
Well, for us, we've seen, I think the 2 words I'd describe are resilience and consistency. We saw throughout the second quarter, while there was some wobble early in the quarter from hotel groups, ours continued to stay strong, and our consumers who typically book about 4 months prior to the summer travel, they own their vacation already. They've planned for it, so they're going to use it. And we didn't see any wobble for us at any point in the second quarter. And then as we look already into the third quarter, travel remains consistent and steady for the next 90 days.
Interesting. So you have a very unique business model, if you want to call it that. So, unlike talking to some of the peers that we would consider in the travel industry, like you said, you have a much more set sort of membership base. So, do you describe yourselves as selling timeshares? Is that, or do you phrase it differently?
No, it's timeshare. Some people call it vacation ownership, shared ownership. Either way, the fundamentals are very straightforward. Is you prepay your vacations. And in times in rising prices like we've seen the last 3 years, the value you get in your ownership is just super noticeable for families who are looking to preserve the value of their vacation dollars. They're definitely going to go. And what we've seen this year is as prices have risen for hotel rates or vacation rentals, they've seen incredible value in their ownership. And for our owner base, which is over 800,000, 80% of them have fully paid for their ownership. So there's no reason for them not to travel. Usually the only decision they make are they going to fly or are they going to drive? And even in those trends, we haven't seen a change. So value, flexibility, and they fully paid for it. So why not get on vacation this summer?
That's interesting. So when these airlines, the big airlines, come out with earnings lately, what they're saying is it's their higher income consumer. It's, premium economy. It's the business class tickets that are doing well. What's your target market at Travel+Leisure? Like, who are you selling these properties to?
So as we came out of COVID, we changed our approach. We saw that Our business was most efficient at a 640 FICO and above, and that's so our minimum standard. But our average FICO for new purchasers is 746. Average household income almost $120,000. And as far as Gen X, Millennials, and Gen Z, that represents nearly 70% of our new purchasers. So it's really appealing to, well, let me flip it around. We're less exposed to that lower-end consumer that you were just speaking to, and we're showing that the higher-end consumer, that 746 FICO traveler is continuing to go on vacation, and we're benefiting from it. Our forward look is showing our bookings to be super consistent for the next 3 months, as well as our portfolio of loans of people who do use finance to purchase their timeshare. There's really been no deterioration in the portfolio that we have.
Mike, in the commercial break, Matt and I were taking a look at the MODL screen on the Bloomberg terminal, taking a look at the different segment revenues for travel and leisure. And you can see the vacation ownership, like Matt talked about, it's been steadily growing over the past several quarters. But then I take a look at corporate. Corporate has been declining, it looks like, for several periods in a row here. And I wonder how you're approaching that part of the business. Are you de-emphasizing this, or is there a plan to turn corporate around?
Well, we basically have two primary segments, and the core of our business, 70% of our EBITDA, comes from our vacation ownership segment. We've launched over the past 3 years, we've rebranded the company from Wyndham Destinations to Travel+Leisure because we want to pursue a multi-brand strategy. With that strategy, we've been able to acquire a core vacation club, a world-class hospitality brand. We've been able to accelerate Margaritaville, and we'll be launching later this year Sports Illustrated Resorts. So we will be emphasizing that segment of the business. The corporate, which depending on terminology, is really a portion of our business, the smaller one, that has structural headwinds that we think will become less a portion of our business going forward. But despite those headwinds, we've been able to meet our second quarter targets of $250 million of EBITDA and reaffirm our full year guidance. So we think we'll see more emphasis on the VO space and less emphasis on the rest of the business going forward. But we think that strategy will lead to mid-single digit growth and incredible return of cash to our shareholders, which is about 50% free cash flow to EBITDA.
Much has been made of a 10% drop, 11% drop in the U.S. dollar from its highs. Mike, does this affect you? How do you look at this? Are Europeans with more money able to come over and spend more? Are you having are you having to pay a little bit more when you buy foreign destinations? What's it mean to you?
Yeah, all the macro news, whether it's currency, inflation, tariffs, none of that has really impacted us, and it's for some simple reasons. 90% of our U.S. 90% of our consumers are U.S. domiciled, which means all of our risk is inside the U.S., which has great regulation. It has great affinity toward brands like ours. So the international travel, the weakness of the dollar, it might affect us positively for European travel to the U.S., but it's really on the margin. It won't affect our full year results. It simply may modestly change our mix. Because of our acquisitions, for instance, Accor Vacation Club is primarily in Asia. All of that cash recycles within the region, and it doesn't create an incremental risk to us. And again, 10% of our business is international. So what we're really watching for is how the U.S. economy and how the U.S. consumer is holding up. And as we saw in Q3, as we're already seeing as we saw in Q2, and as we're already seeing in Q3, that consumer and the U.S. economy, from our perspective, is holding up extremely well.
All All right, that's a good place to leave it. Mike, always great to speak with you. That is Mike Brown. He is the CEO of Travel+Leisure. Let's get a check on these markets. A pretty uninspired trade ahead of a big week. The S&P 500 only higher by about 0.1%. You do have tech stocks with some firm direction. They're moving higher ahead of that big week, currently up about 0.4% on the NASDAQ 100. And the bond market, I'm going to go ahead and call that unchanged on the 10-year yield, maybe a basis point higher. Let's take a look for some action in the single stock landscape with Bloomberg Equities reporter Alex Semenova, and Tesla actually extending gains here, Alex.
Yeah, Katie, one of the big industry stories of today, Samsung Electronics will produce chips for Tesla in a $16.5 billion deal. Samsung, which is, of course, South Korea's largest company, announced on Monday that it secured this agreement, which will run through the end of 2030. The plan is for an upcoming plant in Taylor, Texas, to produce Tesla's next-generation AI6 chip. Tesla CEO Elon Musk said this on X, confirming a Bloomberg News report from earlier. Samsung shares rose to their highest since September, and of course, Tesla up about 2.8% right now. Musk described the value of the deal announced by Samsung as just the bare minimum. He said that he expects actual output to be several times higher. ASML and other European semiconductor equipment stocks are also gaining, given that Samsung is their key customer. We also have Nike climbing this morning after JP Morgan upgraded the stock to overweight from neutral. Analysts cited the earnings impact of the retailer's multi-year recovery plan. JP Morgan analyst Matthew Boss said that he expects the plan to generate positive earnings per share growth in the high teens to 20% through 2030. The recovery plan includes actions like global inventory alignment and a pickup in momentum within global wholesale order books. JP Morgan lifted its price target on the stock to $93 from $64. That's about a 22% increase from Friday's close. And finally, Cheniere Energy and other defense stocks are climbing after the European Union agreed to a trade deal with the U.S. It committed to big purchases, of course, of American energy. President Donald Trump said that the EU agreed to purchase $750 billion in American energy products and invest about $600 billion in the U.S. on top of those expenditures. Guys.
All right. Great roundup, Alex. Thanks so much for joining us with that $750 billion in spending on energy products, $600 billion on infrastructure projects that were not already announced. So a win there, and Wall Street is rewarding this administration. Coming up, staring down a pivotal week of data with the spotlight on Fed Chair Jerome Powell. Speak with economist Julia Coronado of Macropolicy Perspectives. Next, this is Open Interest. Let's get now a look ahead at what's going on in the markets. President Trump continues his visit to Scotland this week, while Treasury Secretary Scott Bessent meets his Chinese counterparts in Stockholm for continued trade talks, bilateral trade talks between those two countries. On Wednesday, the Fed is expected to hold rates steady. We won't know until it happens, but what I can tell you is Tom Keene will be joining John Farrow for special coverage. And after the bell Wednesday, we get earnings from Microsoft and Meta. That is followed by Apple and Amazon on Thursday. So not only are those gigantic companies, but this company this week, I should say, in general, will get 40% of all S&P 500 companies reporting. Is that right? 40%?
You know, you've been saying that, and I feel like it's too late to go back. So 40%.
We'll stick with it for now. And at the end of the week, the July jobs report. Obviously, that's a Friday, and that's when we get those. Plus, President Trump's tariffs are due to take effect. It's August 1st.
August 1st. Rabbit. For more on a crucial week ahead, we're joined by Julia Coronado. She is a former Fed economist who now runs Macropolicy Perspectives. Julia, it's great to have you with us. So we have a Fed meeting, and then we have a jobs report. Let's start with the Fed meeting. The decision itself, not expecting too many fireworks there, but as always, there's a lot to talk about in that press conference, Julia.
Absolutely. There's a lot going on. Of course, Chair Powell will put on his best poker face and reassuring voice and tone, which he's very, very good at, and say that, look, that things are There's a lot of disruption going on. So far, you've got a little bit of creeping higher in inflation, some softening in the economy on balance. They're going to continue to be in the wait and see mode. I do think he will open the door to making an assessment and a possible adjustment at the September meeting. That seems to be the consensus across the committee. And they'll have 2 more full months of data to judge the health of the economy and the state of inflation pressures by September. So that's a lot of information. Right now, it's sort of punting for a couple of months.
Julia, what do you think about, if we get a 15% base level for tariffs globally, I guess supply chains will eat some of that, but the lion's share is going to be paid by U.S. companies and U.S. consumers. How much of that bill does the latter foot? How much do U.S. consumers see coming through in inflation? Is it only going to be 1%? Is it going to be 2% more?
Well, our forecast is for core PCE inflation, the metric that the Fed targets, to rise up to 3% or a little bit higher by the end of the year. So that's a full percentage point on core inflation from where we are now, more than a full percentage point. And that's assuming that consumers bear the brunt of half of the tariffs and that half of it gets absorbed into company margins. Either way, that's a pretty big drag on the economy. If you look at tariff revenues, we're on track to collect more than $350 billion in taxes on the U.S. economy on an annual basis. So we just got a big drop of tariff revenue for July. This is real money, and it's got to be absorbed somewhere. So consumers will continue to see prices creep higher. It takes several months for that full effect to pass through. And in fact, one of the risks to the September FOMC meeting is they'll get August inflation, and by our judgment, that's going to be the peak tariff pass-through. So you could see some pretty firm inflation numbers going into that meeting, which will really complicate decision-making.
So that's the Fed part of it. The other part is, the U.S. consumer and how much this hurts. I've heard some wild, I think the Tax Foundation expects incomes to rise 5% after tax, which would be huge, right? That would be very helpful after one big, beautiful bill. And President Trump is talking about giving rebates somehow to the consumers that he's taxing with these tariffs. How do you make sense of that?
Okay, so let's break that down a little bit. The tax cuts are going to mostly very specific households, mostly high-income companies and households in the near term. Any tax cuts for sort of median households kick in next year. So in the near term, consumers are looking at a hit to their disposable income from rising prices. So we look at the labor market, job growth is cooling, wage growth is cooling. So nominal wage growth is slowing down. Meanwhile, inflation, the prices that they pay on goods and services, and goods in particular, are picking up. And that means a squeeze on the consumers. Then you add in the uncertainty consumers are feeling, and we've seen a lot of hesitation and caution, rising savings rate in the first half of the year, even before any of this actually hits consumer pocketbooks. So I think the risks are that we get squeezed in the second half of the year. There's been some relief in the market that it hasn't showed up so far. But if you look at what we're going to see in GDP, consumer spending is tracking less than half of what it was tracking last year. That's a lot less revenue growth for companies to work with. Add in frictions from tariffs and trade wars. And, it's not an easy backdrop for U.S. companies right now. There's a lot of enthusiasm about what AI can do in terms of resolving some of that squeeze through productivity gains. We'll see how all of that nets out. But this is, the big, beautiful bill does not solve all the problems or the challenges that the U.S. economy is facing.
All right, Julia, unfortunately, we're up against the clock. Really wonderful to speak with you ahead of a consequential week on the economic front. That is Julia Coronado. She is Macropolicy Perspectives president and founder. Now, coming up, trade deals or frameworks? We'll analyze the accords President Trump has struck with foreign nations and blocs next. This is Open Interest.
We'll be announcing on pharmaceuticals sometime in the very near future. We have a very big plan on pharmaceuticals. We want to bring a lot of the pharmaceuticals back to America where they should be. We're going to want to be making a lot of them ourselves, all of them in a sense. But you also have a good pharmaceutical business. We'll be dealing with you on pharmaceuticals.
That was President Trump speaking in Scotland this morning. Trump celebrating over the weekend a second massive trade deal after inking a framework with the European Union that follows his pact with Japan. But these preliminary accords are starting to draw scrutiny, and now some details are emerging for more. Let's go to Bloomberg's Washington correspondent, Tyler Kendall. And Tyler, I'm particularly interested in pharmaceuticals because yesterday the president said the 15% number covers everything but pharmaceuticals, and Ursula von der Leyen says it covers everything including pharmaceuticals. And I'm guessing we still don't know which it is.
Right. So actually, a U.S. official has clarified that for now it appears the 15% will apply to pharmaceuticals. And part of why the European Union was able to secure that lower rate has to do with their investment pledges, including the $600 billion for new expenditures. But we should say that it's not clear if that's actually going to last, because we are expecting a Section 232 investigation into pharmaceuticals to wrap up in the coming weeks. And perhaps that will add additional uncertainty, as our analysts at Bloomberg Economics say. The real risk to this deal really does come down to those sector-specific tariffs and what those are going to look like in the future. We're still waiting for some critical details, including when it comes to the metal tariffs, steel and aluminum. It's our understanding that they will be tariffed at a lower rate under a certain quota, but we still haven't gotten those exact numbers yet. So those are sort of the threads that we're still following here. The one that we know for certain, of course, as you mentioned, is that 15% auto tariffs. That was seen as absolutely critical for getting this deal over the finish line on the European Union side. But we have to see how this all shakes out when the finalized text does emerge.
Tyler, when it comes to that $600 billion investment, as you mentioned, really seen as crucial here to getting this deal across the line. Interesting reporting coming from Politico, citing two senior European Commission officials who clarified that the money would come exclusively from private European companies, with public investment contributing nothing. This is according to Politico reporting, but it makes it hard to really accept some of those big figures that we saw coming from the EU, from Japan, at face value.
Right, exactly. And we actually asked this exact question to Peter Navarro, senior trade counselor to President Trump last week on balance of power. And they're just, the administration just wants the money coming in no matter where its source is coming from. And that's really what they're trying to put forward here, that they're trying to get this investment, even if it's private. That's good in their view, of course, because they're trying to lift those numbers. The other interesting part that sort of sweetened this deal, too, has to do with that $700 billion worth in new energy pledges, but there's also questions surrounding that as well, since we do know that the EU has already started to boost its U.S. LNG in the wake of the war with Russia.
Tyler, thanks very much. Tyler Kendall there from Washington. Coming out tomorrow, we'll speak with Marcy Frost, the CEO of CalPERS, the largest pension fund in the world, plus State Street's Elliot Hentov on trade talks.